Hey everyone, and welcome to today's Explainer. I am so excited you're here. Today we're tackling a topic that honestly often feels completely overwhelming, but is actually incredibly fascinating once you break it down. Yep, we're talking about the stock market. We're going to dive right in and figure out how this whole world actually works. Let's build a rock-solid foundation and just totally eliminate that confusion together, all right? Let's do it. Okay, let's dive right into this, because this is literally one of my absolute favorite stories. So there was this survey in the US, right? They asked a group of 10-year-old kids to pick a basket of 8 to 10 stocks, just whatever they wanted. At the exact same time, they asked a group of highly educated chartered accountants to do the exact same thing. Well, fast forward 5 years, and guess what? The 10-year-olds actually outperformed the financial experts. No way, right? But how? Well, the experts used complex math, long balance sheets, the whole shebang. And the kids, they just picked brands they knew and loved, like Cadbury, Disney, and Barbie. They just implicitly understood the products that real people actually use. And understanding those everyday products can have a seriously mind-boggling impact. Get this. If someone in your family had invested just 10,000 rupees in Wipro 40 years ago, that single investment would be worth roughly 700 crore rupees today. That's right, 700 crore. Even a tiny investment of just 1,000 rupees would be worth 70 crore today. Now, quick note of caution here, actually a very important one. The market absolutely has risks. If you pick the wrong company, that 700 crore potential could just as easily shrink to a 10,000 rupee loss. But that massive potential for growth is exactly why we're here, exploring how to do this correctly.
To get us started on the right foot, here is our roadmap for today's explainer. First up, stock market, myth versus reality. Second, how the market actually works. Third, risk, return, and expectations. Fourth, the magic of compounding. Fifth, you don't need commerce. And finally, how to start investing. Let's get right to it. All right, Section 1, stock market myth versus reality.
So we're looking at the massive gap between the myths we always hear and the actual reality of the market. The myths, movies show it as this chaotic, crazy place where people lose their shirts, and our families are always warning us to stay far away. But the reason for this bad reputation is entirely based on mindset. So many people approach the market with a total gambling mindset. They expect their money to just magically double overnight, or they buy these super cheap 1 or 2 rupee penny stocks hoping for a quick lottery win. And guys, that is exactly how you lose money. The reality, the real secret to success here, is the investing mindset. Think about how people buy real estate or gold, right? They don't check the price the very next morning hoping to sell it. They hold on to it for generations. Treating the stock market with that exact same long-term patience is the real key.
Moving right along to Section 2, how the market actually works.
Let's completely demystify the actual mechanics here. What exactly are you buying? Well, this brilliantly illustrates it. At its core, a share is quite literally a small piece of ownership in a company. Imagine you're investing some money into a trusted friend's new shop. You aren't giving them a loan, so you don't get a fixed interest rate every month. Instead, you get a slice of the profits if the shop does well. And, yep, you share in the losses if it struggles. It's really that simple. When you buy a share in Tata, Reliance, or Godrej, you are simply becoming a co-owner of that business. So let's trace how the money actually flows in the real world. Say a company wants to build a massive new car factory, and they need, say, 20,000 crore rupees. Banks just can't lend that much money to one single entity. So what does the company do? They come to the public. They present their business plan, and the public invests their money. In return, the public receives shares of ownership. But wait, what if you invest and then 2 days later you suddenly need your cash back? The company can't give it back to you. They've already started laying bricks for the factory. And that is exactly why the stock exchange exists. It's simply a secondary marketplace where you can easily sell your shares to another person who wants to buy them, which provides constant liquidity. Okay, on to Section 3, risk, return, and expectations. Setting realistic expectations early on is honestly the absolute best way to avoid falling for those ridiculous get-rich-quick scams. If you're investing carefully in a high-growth economy like India, targeting an 18% to 20% annual return is a very realistic and, frankly, excellent expectation. Let's put that into perspective for a second. At 20%, your money doubles roughly every 4 years. Compare that to a traditional fixed deposit at a bank, where it might take 11 years just to double. The stock market can yield 3 times the return of an FD. But remember that risk we talked about? To manage the risk of losing your money, the golden rule is diversification.
By spreading your investment across 8 to 10 different companies, if one single business fails, your entire portfolio isn't wiped out. You're protected. Which brings us perfectly to Section 4, the magic of compounding. Now, you might be sitting there thinking you need millions to start making real money. But let's look at how wealth is actually built over time. What's really interesting here is the math. It turns out wealth building is incredibly accessible. You absolutely do not need a massive lump sum to get started. Check this out. Let's say you start by investing just 1,000 rupees a month, an amount pretty much any beginner can manage. The trick is to increase that monthly amount by just 15% every single year as your salary or your income grows. If you do that consistently and earn just a 15% return, not even the 20% we talked about earlier, in 25 years, you will hit 1 crore rupees. It's like magic. Time and consistency literally do all the heavy lifting for you. Section 5. You don't need commerce. A huge barrier for people is feeling like they don't have the right educational background to do this. But let's put that fear to rest right now. Whether you're in engineering, arts, science, whatever your background, you are perfectly equipped. Remember our story about the 10-year-olds beating the chartered accountants? Well, this quote sums it up perfectly. Observation beats financial modeling. The kids won because they simply observed the real world around them. They noticed what toys their friends played with and what chocolates they actually ate. If you're an engineer, you probably know which electrical companies make the best components, right? Ground reality and understanding the customer experience are often way more powerful than any complicated financial spreadsheet. In fact, there's some really fascinating data suggesting that female doctors are among the absolute best investors out there. And you know why? Because they are incredibly busy. They literally do not have the time to sit in front of a computer screen overanalyzing charts or panic selling every single time the market dips. They buy solid, familiar brands, get busy with their incredibly demanding lives, and essentially just forget about their investments. Because they aren't constantly tinkering and trading, they save a ton on transaction costs and allow that magic of compounding we just discussed to fully take effect without any interruption.
And finally, Section 6, how to start investing.
So, you understand the mindset, the mechanics, and the math. Now, how do you actually execute this blueprint today? So, the crucial point here is how shockingly fast and cheap it is to get off the sidelines. First, just gather 3 basic things: your Aadhaar card, PAN card, and your bank account details. Second, open an online DMAT account. Platforms like Zerodha, which are discount brokers, are a fantastic option. Opening an account costs around 300 rupees, and the whole shebang is paperless and totally online. Finally, within 3 to 4 days, your account is active. And honestly, the best part? If you're buying shares to hold for the long term, what the industry calls delivery, the brokerage commission is essentially 0. It is practically free to invest. Now, if you're fired up and want to keep learning, here are some absolute must-read resources for your next steps. For books, definitely check out Investonomy by Pranjal Kamra, the absolute classic Rich Dad Poor Dad, Peter Lynch's Learn to Earn for brilliant, simple basics, and the slightly more advanced The Education of a Value Investor. For more structured learning, you can look into the BSE Institute Value Investing course. You can also hunt down reports like My First Investment or subscribe to daily newsletters like Ticker Tape just to keep your financial knowledge sharp every single day. Well, we've covered a whole lot of ground today, haven't we? From debunking those scary myths to the exact literal steps you need to open an account, you now have the beginner's blueprint. The stock market isn't some scary casino. It's a tool for compounding your wealth over time by co-owning truly great businesses. So I want to leave you with this provocative thought to kickstart your journey. Look around your home. Look at the products you use and trust every single day. Use your power of observation. What's it going to be? What will be your very first investment? Thank you so much for joining me on this explainer, and happy investing.